All right, we're going to continue talking about Chapter 11 problems, and we're going to move on to practice exercise 11-3A, entries for cash dividends. So, periodically, organizations may decide to pay out dividends to their owners, who are the stockholders, and sometimes those dividends are cash. And as we talked about in class, there's 3 important dates to remember. One is when the board of directors declares the dividend. So the board gets together and votes and they say, we're going to pay dividends out to our owners. And that's the declaration date, and that's when they become payable. You owe them, right? It becomes a liability. You owe the dividends to the owners. The record date is this date that they established, because for a lot of companies, stocks get bought and sold all the time, right? So you can go on the New York Stock Exchange and buy a stock today and turn around and sell it the next day. So the record date means whoever is the owner on that particular date, that's who gets the dividends. So that way, if stocks get bought and sold, the person who's going to get the dividends is the one that's on that date. And then the payment date. So they're not going to actually give the cash to the owners. All right, so there's 3 dates here. There's a couple different things going on. There's declaring the dividends, which means there's a liability now. And then there's the actual paying the cash out. All right, so let's just work this. All right, so the first thing that happens is they're declared. So that is what creates the liability, dividends payable. All right, so the date for that is August 1st. Right, so on 8/1, we have cash dividends. Doesn't mean we've paid cash out yet. It just means we've declared a cash dividend, which means we have a dividend payable, right? So cash dividend payable. And they just tell us the amount, so we don't have to do any math. $1,250,000. Right? And $1,250,000. All right, the next thing that happens is whoever's the owner on October 15th gets paid that. So that's nothing's happening. There's no actual transaction. That's just what we call the record date. So they come there. On November 14th, they paid the dividends. All right, so that is something that happens. Some cash goes out because it's cash dividends. So cash goes out, and the payable goes away. All right. So on 11/14, cash dividend payable, $1,250,000. Right? If we increase the liability with a credit, when we pay it off, we decrease it with a debit. So cash dividends payable, and then obviously they're cash dividends, so what we're paying is cash. So cash and going out is always going to be a credit. All right, and that's it. You're done. You declared your dividends, you established your liability, you got rid of your liability when you paid it with cash, and you're done. Let's go on and look at the same sort of transaction, but you're not going to pay cash, you're going to pay stocks. All right, so maybe an extra step or something, but maybe calculating some values or something, but not a different concept. We're still declaring dividends, creating that payable. We're still creating dividends and making a distributable. It's called a distributable rather than a payable, but it's still the same idea. We're going to pay them sometime in the future with some stocks. All right. So 11-4A. Here's a corporation that has 250,000 shares of $40 par common stock outstanding. Right? They declared a 2% stock dividend to be issued to stockholders. So stock dividend means we're going to pay you in stock. So the last one we did was a cash, but this time we're going to actually pay you in stock. So that's kind of a cool concept. I like that. So they're going to get some stock sent to them to be issued May 2 to the stockholders of record on March 27th. The market price of the stock was $52 on February 15th. All right, so we got to kind of split out this market price, right? Just like we did when we issued stock. This is the same kind of deal. It's kind of like we're issuing stock again with a par value and a market price, but in this case, we're not getting cash in for it, right? We're giving this stock out. So, but we still have to split up that par value and that excess paid in capital in excess of par. All right, so we have to split those up again. All right, so we got a little bit of math to do, not a lot. Right? So the thing we have to figure out is what is the dividends instead of cash. What are the dividend? What are we actually giving them? Dividends. All right. Well, the dividends is what the stock is worth, right? So it's on the market. It's $52 per share, right? And we have to figure out, well, how many shares? It says 2% of 250. So I have to take 250,000 shares, right, times 0.02, because I have to figure out what's 2% of 250, right? So that's 5,000, right? 5,000 shares, right, equals 5,000, right? So that's how many shares are getting issued, right? 2% of that 250,000. So then 5,000 times 52 is equal to 260,000. All right, so this is what we're actually issuing, right? We had to figure out how many shares, and then of those shares, what's the cash value? So that's actually our dividends right there, 260,000. But we have to split that into the par and the paid in capital in excess of par, right? So the par value is $40, all right? So we've got that. So par, right, equals those 5,000 shares we're issuing times 40,000. So that's 200,000, right? And the difference is 60,000. And if you wanted to, you could take 5,000 times 12, right? 52 minus 40 is equal to 12. 5,000 times 12 is equal to 60, or just the difference. 260 minus 200 is equal to 60,000. Whatever works best for you. But now we have all our numbers, right? So this is the excess, right? So we have the excess, the par value, and the actual dividends declared. So we're ready to go ahead and do our journal entry. All right. So there's the journal entry for when we declare them, and there's the journal entry for when we actually distribute them. All right. So the first date was February 15, when the board met and they said, we're going to pay everybody 2% stock dividend. All right. So instead of cash dividend, we just write stock dividend. So, right, it's either cash or stock. I suppose they could pay something else, but I don't know what. So we decided that the whole total dividends was 260. Right, so there's 260. And then we've got our stock dividends distributable, right? Just like we had cash dividends payable, we're just going to call it stock dividends. You don't really pay stock, you distribute stock. So we're going to call it stock dividends distributable, which is our par value, right? So that's 200,000, right? Right? And then we're also going to have what we call the paid in capital in excess of par, right? So paid in capital, excess of par, 60,000. All right, so we did that. All right, now, we're not actually distributing this. What we're distributing is the 200,000 in stock, right? Because to us, we didn't pay $52 per share. That's the face value of it. That's how we got this excess of par. I mean, that's the sale value, the market value. But what we're issuing is our own stock that we hold, so we only issue it at par value. So when we go ahead and distribute it, right, get rid of this payable, this liability, we're doing it at the 200,000, right? So we've got on the date that we distribute, okay, so nothing about, we don't really care about March 27th for a transaction because that's just the date, whoever owns it on that date is going to get, so May 2nd. So we're paying out on 5/2 the 200,000, right? So stock, dividends, distributable, right, is a liability, so we're getting rid of it, 200, right? And then we pay out the common stock, or we increase our common stock, right? So 200, and that's it. There you go. We've distributed common stock as a dividend. All right, so good luck with that. We're going to do one last problem, and then we'll be done with this chapter.